Hello, it's Jimmy. Do you know what time it is? It's time to start investing. Because time in the market beats timing the market every time. I want to define what investing is. That's saving money in a special way. Not in the special way that you loved your teddy bear as a child, but in a special way meaning 5 years or more. So you're going to be saving money that you won't need for at least 5 years. And by saving, putting it away in some type of appreciable asset. Most of the time I use something like a mutual fund, and recently I started investing in an ETF or exchange traded fund for a very particular reason. And it's money I won't need for at least 5 years. So I'm going to ride the market up and down, and that's fine. It's probably going to appreciate. And if it doesn't, it's not going to hurt me all that bad. Saving just by itself is a little bit more short term. So, a simple money market account that's getting a little bit of interest, but not quite what market gains would be if it were out in the stock market. Or just a regular savings account at the bank. I keep money in there that I'll need within the next 5 years for a little, maybe home improvements or travel and a few things that I buy throughout the year that I know I'm going to need to save up money month to month for, but then spend that money, such as property taxes and insurance, normal, boring stuff like that. I really don't want to invest my property tax payment in the stock market, because that could be a problem if the market were to take a big dip and then I can't pay my property taxes. All right, with that explanation out of the way, I want to maybe talk about being anxious with investing and why that's not a helpful thing. I get it. It can be a little nerve-wracking to put money into the stock market through whatever vehicle you might want, mutual funds or ETFs or other products that have market exposure. It can be a little daunting because, that there's no guarantee that money is going to go up. A lot of the anxiety that I've felt over the years has not really been a worry about whether it will grow, but more on the buy side, is now the right time to do it? And I've done the research and I've picked my investments, but sometimes it's just a little nerve-wracking to pull the trigger and actually buy those investments. One thing I discovered is that the perfect timing for that will never come. So I recently started investing in an ETF for a particular savings goal that I have. And really the reason that I did that over my typical mutual fund buy is that I was able to buy it in much smaller lots. So for the way that I invest through the mutual fund company that I use, the minimum investment is $3,000. And I didn't really have the $3,000 to open a new account, a new savings account for the particular thing I want to save for. However, with ETFs through this company, you can buy them in smaller lots or partial lots. I forget how they phrase it, but what it essentially means is less than $3,000. I could buy $1 worth if I wanted to. I believe that really is the minimum. Fractional share, I think, is the term I'm looking for. All the time that I've been investing in mutual funds, I don't really worry about the price. I just put my market order in and it goes and it buys the shares and they sit there, and that's great. Now, mutual funds are priced based on the close of the day, of the trading day. That's what the price is going to be when you go to buy it. ETFs are sort of like stocks where the price can fluctuate throughout the day, the trading day, and you put a market order in just like a stock, it will snap it up as soon as that order gets processed. So your day-to-day price, or I should say within that day, that price is going to fluctuate. Now, it won't be real wild most of the time with ETFs. They, depending on what you pick, if it's a bunch of eggs in one basket, different kinds of eggs, probably fairly stable, but just something to keep in mind that price does change. That being said, that's where I got a little bit of anxiety over actually buying that ETF because I kept seeing the price move. It wasn't a fixed price based on yesterday's close. Okay, well, all that technical information aside, it was a thing I needed to overcome. I knew I had done the research on the product that I wanted, and I wanted to do it, but I just needed to do it. And that brought some flashbacks of when I was very young and started investing and kind of having the paralysis through analysis and not actually doing the investing, even though I had done the research and knew what I wanted to do. Watching those prices move up and down caused me to hesitate a little bit. The thing that I struggled with early on and what I see other folks struggling with now is waiting until the market is right for them. They're looking for, of course, a low price because we're taught the mantra to buy low and sell high. But if you never get into the market, that advice doesn't mean squat. And really, that's for like single stocks, which I don't really recommend. But the market as a whole, you just kind of need to dive into it smartly. Do your research. Find a investment vehicle that works for you and be conscious of the tax implications of that. Is this something that you don't pay taxes on now, but will when you pull the money out? Or do you want to lock it into some tax favored accounts, such as a retirement account? Do the research on it, but then you actually need to do the work. Don't wait around until you have I know that this investment, this mutual fund needs $3,000. So I'll just wait till my savings account has $3,000 in it and then I'll do it. And if you're then not that disciplined, it's never going to come around. So just figure out what you need to do it and then do it. I think for me, the easiest way was to do some automatic payments. I think the Roth IRA comes out maybe on the 22nd of the month, each month, and it just does it. I set the amount that I want to come out and told my advisor, because I do have my Roth IRA through an advisor, which is good. I'm quite disciplined, but he helps me from being stupid sometimes, even though I consider myself reasonably intelligent. I feel a lot safer doing it. There are other things I invest in on my own without the advisor's help, and that's perfectly fine. And if I let that money slip through my hands, well, that's shame on me, but so far I haven't had a problem with it. But yes, things like an automatic draft from your bank account is a good way to fund those things. Set it and forget it. Another way to do it is through payroll deductions. If your company sponsors a retirement plan, that is an excellent way to set that up and let the money automatically go into it. Then you aren't forced to sit down at the end of the month and figure out where to put that money. It's already done for you. And it's weird if you do not plan for your dollars, they will just figure out a plan on their own. So yeah, go ahead and do a little research, pick the investments that you want to put in, and set up some automatic payments and then let it go. It's good to keep an eye on it, check on it after you've made your decision, just to make sure things don't stray off course. About once a year, I do a little bit more detailed look at the performance of my investments. And the other thing I want to make sure is that they are balanced in the 4 types of funds that I want to be invested in for the long term. And occasionally, one type of fund will be a little out of whack, and then go back and correct that. Then it's time to rebalance. But I'd recommend not doing that too frequently. There are fees involved in rebalancing portfolios. And I figure if you just mess with stuff too much, that's not good. Again, I do recommend paying attention to what's going on and knowing what your investments are up to, but just don't play with it too much. It's good advice for a lot of things. So I guess my big takeaway for today is, jump into the market. Don't wait. I would suggest, like diving into a pool, be sure there's water in the pool and that you're at the deep end before you jump in, but don't chicken out on on top of the high board. Just, go for it. Investing wise, that is. Don't take my advice on swimming or diving. I have absolutely no experience in that. But again, do your research, pick something, and then do it. And then leave it alone. And then come back in 30 years and tell me how you did. Well, that's all I've got on jumping into the market. As always, thanks for watching, and I hope you're having a great day. Well, with that out of the way, now let's talk a little bit about... Well, now with that convoluted explanation out of the way, let's talk a little bit about... What am I talking about? Okay.